there was a major announcement with Oracle and OpenAI, the largest AI provider out there in the world. And OpenAI has basically promised to provide $60 billion a year to Oracle for their services, their cloud computing services. $60 billion a year. Now, do you know how much revenue OpenAI generates today? About $14 billion. The delta between $14 billion and $60 billion a year is huge. So you see why we're just looking at these valuations saying something's probably a little bubblish right now. Welcome to Life in the Markets. My name is Tim Russell, and today is Monday, October 13th, 2025. It's been an interesting week in the markets. As we looked at what happened last week, we saw that the vast majority of the week was generally positive right up until Friday. Friday morning, Donald Trump made a post about some new tariffs that he was applying to China in response to their new restrictions on raw earth minerals. This new tariff announcement and the appearance of a new heated up trade war with China caused the stock market to sell off, and we lost all of the gains that we had received earlier that week. We closed down on the week. Almost every asset class traded down on the news. So if we look at the markets, we saw the S&P 500 was down 2.7%, NASDAQ down about 3%, Russell down 2.35%. Gold was up. Gold's one of the rare winners last week. It was up 3.6%. Silver was up 5%. And oil was actually off about 2%. Bitcoin, for those of you who are interested, Bitcoin traded very much with the rest of the overall market. It's actually down about 5.8% for the entire week. Bonds were the other bright spot. This news and the tensions with China caused bonds to rally. They were up about 0.4% for the week. We see the 10-year Treasury, that yield actually went down to 4.075, which is good news for bonds. Lower yields for new bonds causes the relative value of older bonds to look a bit more attractive. All right. So as we've looked at what happened last week, I think there are three big stories that are worth your attention. The first one has to do with Donald Trump's post about China. What's going on with this new Chinese trade war? That's a great question. Well, the answer is that the S&P 500 was trading up at or near all-time highs before Donald Trump took to Truth Social and announced additional retaliatory tariffs against China. Why? Well, China, the day before, this is Thursday evening, Beijing announced that they were placing significant restrictions on the export of rare earth metals and trying to avoid allowing international corporations to use their metals for the critical components in computers and other tech-related products. Obviously, this kind of a move by Beijing is a complete reversal for the productive conversations that Trump and his administration have been having with Xi's political officers there in China. And this is very much took the markets by surprise. It seems as though it took Donald Trump by surprise, and Donald Trump's retaliatory efforts are really an attempt to be able to say, pump the brakes on this. Let's not get ourselves out over our skis. From what we see coming out of China, they seem ready and prepared to engage in a longer, more heated negotiation, I guess partly their part of trying to get a better deal out of Donald Trump. I think Donald Trump is likewise going to try to use this to try to get an even better deal out of China. We'll have to see who wins. It seems like it might be a game of chicken. However, there are some other things that might be going on behind the scenes that may be causing some of this. Now, everything I'm about to tell you is entirely speculation. I've been listening to some individuals who know the Chinese political environment in much greater detail than I do, and they're saying that there are possibly two explanations that may explain what happened on Thursday, and I think it's worth considering. The first explanation is that on I guess the middle of last week, early to middle of last week, there were some rumors circulating around the internet. Obviously, this is outside of China's internet, that President Xi may have had a stroke last week. And if that's the case, and if he's medically compromised and he's already at risk right now with his political power and prestige within China, which seems to be a pretty settled fact that most individuals looking at China think that he's not quite as strong as he once was. If that's indeed the case, this may be a move by the Communist Party of China to create or to manufacture a crisis in order to pump the brakes on Xi's public presentation or public meeting with individuals. Now, Donald Trump announced that he was no longer going to be meeting with President Xi next week when they were supposed to get together at an international summit. This may be exactly what the Chinese party was looking for if they were trying to prevent Xi from having to get out into public before he's fully recovered. Again, this is entirely speculation. We do not know for a fact that those things are true. China obviously keeps these things very much under wraps. They're a very secretive organization. If it's true, it's certainly interesting. On the other hand, let's just assume for a minute that it's not a medical emergency causing them to manufacture a crisis to kind of change the story from Xi's health to the trade war. If it's not that, then possibly what they're saying is that, as I mentioned earlier, Xi is weak politically. In fact, there are significant components of his party that's pushing to have a new direction for the country and a new leader to step in and guide the communist nation towards their utopic version of the future. In this scenario, we have in a few weeks the Communist Party getting together and voting on the future of the Chinese party. With Xi's position being weakened, this is just the kind of thing that Xi would do to create or manufacture a crisis, create conflict with America so that you have to keep the status quo in power and in place to ride through this crisis and settle things out with America so that he can retain power in the next cycle. Again, none of this is confirmed, but certainly interesting. At the very least, I would say keep an eye on what's going on in China over the next few weeks and months. We could potentially see some interesting shakeups with our overseas partners there in China. All right. Let me move on to the next major story or issue that we're facing. Now, we deal with a lot of clients here at the Life Group. We're having lots of conversations all week long. And one of the interesting things that we're hearing from clients, that we're hearing from some of our product sponsors and from other industry experts, circles around the question, are we in a new bubble? Is the stock market a bubble? Is the bubble about to burst? These are really interesting and challenging questions, and I'd like to take a moment to try to address them directly. First, I want to tell you that the answer is yes and no. Are we in a bubble? Yes, and no. Let me explain. The first, I think it would be helpful for us to recognize that bubbles are typically focused on an industry or industries that are significantly overpriced. They're generally not wide market kind of everything bubbles. One notable exception would be in the late 80s, Japan had an everything bubble that was for lots of different reasons, and that led them into a very bad 20-year recession. That's not what we're seeing right now. Right now in America, we are seeing bubble-like behavior generally in the tech industry, but very specifically around artificial intelligence. It's very much one of those wild scenarios where we get like sitting here looking out at individuals who are investing and managing assets in this space. We have very different presentations provided to us. On one hand, some individuals are so excited about AI and the potential revenue growth that AI will invariably, according to their opinion, generate, that buy anything you can at any price because this thing's going to the moon. Now, they don't use that phrase, but they do say that we could see billion or trillion dollar valuations as a normal course of business over the next 10 years because of the growth AI will provide. Now, who would not get excited about that? Everyone likes bigger and better, right? On the other hand, we get the other side of the coin, which says, hold on, pump the brakes. This is not a proven technology. We've got a lot of things that we've got to work out. We do not have the infrastructure, not the technological infrastructure, not the energy infrastructure, not even the storage capacity or the computing power to do the kinds of things that's predicted in the revenue structures right now. So all of these valuations are today's values are just way, way too expensive, and it's going to take a long time for us to develop the kind of energy infrastructure and computer infrastructures to be able to deliver on the kinds of hopes and dreams that those looking at AI are seeing. I'm going to be really honest with you here. I tend to believe more of the latter than I do the former. I think that there's more hype over artificial intelligence than there is real substantive value here. Let me give you one example of this. You may have heard a few weeks ago, there was a major announcement with Oracle and OpenAI, the largest AI provider out there in the world. And OpenAI has basically promised to provide $60 billion a year to Oracle for their services, their cloud computing services. $60 billion a year. Now, this is over the next several years. It's not supposed to start right away. Here's the question. Do you know how much revenue OpenAI generates today? It's estimated that by the end of 2025, OpenAI would have generated about $14 billion. The delta between $14 billion and $60 billion a year is huge. We're talking multiple times the size of the present OpenAI. Now, I do admit there is growth potential in AI. We do expect revenues to grow, but that's a lot of growth. Now, let's just look at this a little bit further. And this is also, this analysis comes from Michael Simbalis from Morgan Stanley. He points out that right now, Oracle does not have the capacity to provide the services that OpenAI has demanded. In fact, they haven't invented the things yet to be able to deliver the service. And further, these services are expected to require, get this, 4.5 gigawatts of power. Now, for those of you who not really up in your gigawatts, that would be the equivalent of 2.25 Hoover dams worth of power generation. We would need 2.25 more Hoover dams to be able to satisfy Oracle's power need to provide for this service to OpenAI. Maybe another way of looking at it, we would need roughly 4 new nuclear power plants kicking out about the 4.5 gigawatts of power. That is huge. Like I said, we don't have the energy infrastructure, and I don't see a ton of appetite to create an awful lot more nuclear power. So you see why we're just looking at these valuations saying something's probably a little bubblish right now. Here's the problem. The markets can stay irrational and prices can stay high a whole lot longer than you can stay solvent. That's not my words. That's a famous quote. I can't even remember who said it now. But let's face it. When we're looking at a bubble, we are looking at irrational prices. And I have no way of telling you when the bubble is going to burst. I don't know. The reality is that we could see the market continuing to move higher. We could be at the low for the stock market over the next 10 years. Today's price could be the lowest price you see over the next 10 years, or conversely, today's value could be the highest value you will see over the next 10 years. We fundamentally don't know. I can't tell you when this bubble is going to burst. Well, then how should you invest in a market like this? That's probably the right question. I would first of all tell you, I'd warn you, don't simply chase this AI craze just for the joy of it. Now, recognize your risk level. If you want to put money into artificial intelligence, you certainly can do that. Just recognize that this money may go away when the bubble bursts. When we saw the tech bubble burst back in the early 2000s, we saw the vast majority of the companies that were scooped up in this tech frenzy go to zero. So just be prepared that could happen. Which is why we at the Life Group are trying to guide our clients into portfolios that are wisely constructed with a prudent approach to managing the amount of AI exposure. Now, let me tell you, when we say manage the amount of exposure, it's impossible to have zero exposure. Everything's connected to everything. The AI bubble has its long fingers in lots of different industries and in many different companies. So yes, if that bubble bursts, it will affect a large majority of companies around the world. However, not all companies are going to be affected the same. There will be some more winners and more losers than others. So that's part of the reason why we at the Life Group are trying to construct portfolios that have a wise approach to how we engage with artificial intelligence within the companies of that portfolio. So this is a big task. This is a big undertaking. We don't take it lightly. We try to work with our clients to understand what is your risk appetite and what is your risk capacity. Risk appetite means how much risk are you willing to take to get the kind of growth you want to get. Risk capacity means, well, if you lost everything, how bad would that hurt you? Do you have the capacity to suffer substantial losses? What most individuals find is that they have a certain capacity for risk, and for those who want the growth, who have the appetite for growth and the capacity to take the risk, they're welcome to engage in investing in this AI bubble. Just don't be surprised when it bursts. The other thing I want to say is that for the rest of our clients who are more risk sensitive, we're doing the work right now to make sure that the assets that you hold have a well thought through philosophy or approach to the AI world, and one that hopefully will help bear us through any potential storms that may come. The key is not, is the market in a bubble or is the market going to burst? The answer is probably it is. The key here is, what do we do about it? Do we maintain diversity? We don't trace hot stocks. We don't just buy growth at any price. We want to be prudent, disciplined investors, and that's what we at the Life Financial Group do. So if that's something that you want, then certainly reach out to us at the Life Financial Group, and we'd be happy to set up a time to talk with you about helping you create a strategy that's the right fit for your needs, given the kind of environment that we're in right now. The last thing that I think you should probably pay attention to is that there was an interesting announcement from the IRS last week. Many of our clients love taking advantage of qualified charitable distributions, QCDs. These are for individuals who are 70 and a half years old or older who have to take required minimum distributions, those are RMDs, out of their retirement accounts, their IRAs. The government allows you to take the distribution, have the check payable to a charity of your choice, like your church, and you satisfy the RMD requirement, the mandatory minimum distribution, but it also allows you to avoid being taxed. The problem is that the 1099, the tax form that you got, the 1099-R, would call the entire distribution taxable, even though a portion or all of it was given to a charity. The IRS announced last week a new code that should go on the 1099-R, which will help prevent tax preparers from accidentally marking your distribution as taxable and help to save you money. Now, at the Life Financial Group, we're working with many of your tax preparers to help make sure that those QCDs are labeled and accounted for correctly on the tax return. So we're already doing that for you. This announcement's simply going to help make sure that happens more consistently and with a greater amount of confidence for you and also for us. Take advantage of qualified charitable distributions. Let your parents know if you're too young for them. They're a wonderful way of giving to charity, not getting taxed on the distribution, and being able to hopefully reduce your overall tax burden because it may reduce the amount of Social Security subject to income tax. A lot of good things in QCDs. As we wrap up today's meeting, I would like to tell you about a verse that I think should be an encouragement to you. It's from Ecclesiastes 5, verse 10, and it says this: "He who loves money will not be satisfied with money, nor he who loves wealth with his wealth." We talked about a bubble, and we talked about the desire for more and the craving to have the growth at any price or any risk. And one of the things, and I'm not saying this is you, I'm just saying, think about this. If your overarching desire is, I need to get into this bubble, I don't want to feel left behind, just how are you doing with the feeling of greed and covetousness? Just be careful about that. You love money so much, you're actually never going to be satisfied by money. It's not something that can meet the deepest need in your heart. Only Christ can do that. So, brothers and sisters, as you're here today, you're listening to my voice, just look at Christ. Be satisfied with him. Go pursue Christ. Make him your chief and sole desire as you pursue godliness and Christ-likeness. And the Bible says, seek first my kingdom and all these things shall be added unto you. So do that. Seek him. Follow wise stewardship principles, as we point out here in the book, The Good Steward. And as you do that, very often what results from it is financial success. But you see, you're not chasing money. You're not chasing wealth. You're chasing Christ and following his principles, which typically leads to success. So brothers and sisters, pursue Christ. Make him your chief desire. Everything else will work out. All right, until next time, take care. God bless. Be safe in the markets.
The topics discussed in this podcast are for general information only and are not intended to provide specific investment advice or recommendations. Investing and investment strategies involve risk, including the potential loss of principal. Past performance is not a guarantee of future results. All information herein is from sources believed reliable, but is not guaranteed for accuracy or completeness. The team assumes no liability for any errors, omissions, or actions taken based on this material. Information is as of the date stated and subject to change without notice. Securities and advisory services offered through Genius Wealth Management, member FINRA and SIPC.